Good morning. Welcome to Good2Know Talk Series. Before the delay, had a little bit of technical difficulties logging on. Hopefully others aren't having trouble logging on. But welcome to Good2Know Talk Series, where our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. Here we understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and excuse me, an owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. With us this morning, we have James Kong. James is a financial advisor at Edward Jones, and he works with small businesses, individuals, and families to identify their risk and develop strategies to help them reach their short, mid, and long-term goals. James, are you on the line right now? I know. Oh, good morning, James.
Yeah, Janine, can you hear me?
Oh, okay, there you are. Sorry, I thought I would.
Sorry about that.
No.
Good morning, how are you?
Good. I think this morning everyone's having a little trouble logging in.
Yeah, you know, there's a problem with my system too, so I'm going to try my best that I'll look through my PowerPoints here, and then if you can scroll through them as I'm talking, and then in the meantime, my assistant, she's trying to get things squared away with the system, but if you can just kind of follow my lead with the PowerPoint, then that would be perfect.
Oh, okay. Yeah, no problem. Yeah, I'm actually excited about today's, all of us have heard about, we're aware of pensions, but, there really are a lot of other options that business owners should be aware of. I'm excited to
hear what
you have to say.
Yeah, and I think the two that we're seeing more often nowadays are cash balance plan, which is the new age, pension plan, and then also executive bonus plan. So I'm going to probably keep it high level just to go over the basics. And when I go over the sweet spots, for those tuned in, just jot down notes that, if you're of a certain demographic, that it may be something to consider. I'm not going to jump into the technicalities of each strategy, but just keep it high level so you can try to identify what's going to be the best strategy for you.
Okay.
Okay, so I'll hop into it. And so if, Janine, you can get to the first slide, creating a business retirement plan. And it seems like a simple question, but oftentimes, they say, hey, James, I'd rather just bonus myself out, spend my money now, and then I'll worry about everything later. The primary benefit is, you're going to be generating a tax deduction for the business with some of these plans, and they offer tax efficiency in terms of how the asset grows. So whether it's, growing tax deferred or growing tax free, those are some of the benefits with these strategies. Okay. I think the biggest concern now that I have is inflation risk. And so these investment vehicles can give you an opportunity to either outpace inflation or at least keep up with inflation in a low interest rate environment. And then, you know, as I kind of preach to clients is, you know, save more now, retire earlier. And so some clients say, James, I like spending my money now, and that's fine by, you know, all means, but I usually use a pocket analogy. And so as we're working, we just imagine that we're putting money into our pocket, in our front pockets, okay? We're spending it on a regular basis, and then from that money that we're earning, some of it's going into the IRS's pocket. But people don't realize and understand that if they don't put money in their back pockets, budget, save, and invest, then they're just going to kind of close their eyes, cross their fingers, and hope for the best in retirement. So we're just, again, enjoying the life that you're living today, but then also budgeting, investing, and strategizing for tomorrow. I'll be down in a sec. Balance plan. And so it's going to be your new age defined benefit or pension plan. And what does that mean? So essentially, you as the business owner, the employee credits an employee's account based on their yearly compensation to solve for a guaranteed pension or income stream in retirement. Yeah. So the employee is not responsible for choosing, funding, and managing the investments like a 401k plan. So this really dumbs it down for the individual that says, James, I don't want to watch the market. I just want my employer to put aside money for me. They manage it, and I'm guaranteed a set amount at retirement. And so the retirement benefit is usually dependent, and the contribution rate is dependent upon the employee's age, compensation, and tenure. And again, this is different from a 401k plan in which the retirement benefit depends on the investment performance, how much the employee is funding the plan, and how much the employer is funding, whether it's matching or profit sharing or a cash balance strategy. Yeah. Next slide. So, you know, we want to layer the tax deduction strategies. And for those maybe small businesses that are just getting up and running, it's probably best practices that they just set up a 401k. And once they get to a point where they can deduct more than $18,000 a year with the salary deferrals, then they add on the layer of the profit sharing. And then for those under 50 years old, you can deduct and contribute up to $54,000. For those over 50, you can deduct up to $60,000. And then once business owners say, James, Janine, I put aside $18,000 to generate a deduction. I put aside $54,000 in profit sharing. I still need to generate more deductions based on how much I earn. That's when the cash balance will come into play. But again, cash balance isn't for every single business. It's for that business owner that really wants to accelerate funding their retirement and in turn get more deductions for the business.
Sorry, James.
So when we look at the suite, go ahead.
Are you on? Are you on the?
Yeah, I'm still here. Can you hear me?
Yep, I'm. Okay, yeah, we can hear you.
And so the next slide is going to be cash balance sweet spot.
Oh,
and
okay.
So,
James, let me catch up on the slides here. Sorry, I think I
sorry about that.
Fell behind.
Yeah, so we should be on the 5th slide just after the pyramid.
Okay. Oh, sorry. Sorry for our listeners. I was so busy listening to James that I didn't keep up with my slides.
Yeah, no worries. Yeah. It's going to be just after the pyramid on slide 5.
Okay. I think I'm Okay, the sweet spot. Okay,
Yep.
we're
So
this deep.
cash balance sweet spot, again, you're going to use it as layers. The salary deferral with 401ks, you'll get the 18,000, and again 24,000 if you're older than 50. Thereafter, if you're still looking to generate deductions after profit sharing, it's going to be 54,000 for those younger than 50 and 60,000 for those older than 50. So on to the next slide. Another sweet spot would be business owners older than 50. And so like a pension and defined benefit, the older the owner, the more the benefits or contributions could be skewed in favor to the owner. Another aspect is if they're consistently making around 250,000 a year, so to sufficiently fund the strategy and maximize your deductions, you want to make sure that cash flows are somewhat consistent in which you're earning 250,000 per year. Next slide. Industries in which I see a good fit would be professional services, attorneys, dentists, doctors, realtors, some mortgage officers, in which there's a wider margin between the compensation for those key employees versus maybe administrative or rank and file. So the bigger the spread or margin, the more favorable it could be to those either older employees and those higher compensated employees. And then lastly, small business owners. The smaller the business, the more the benefits can be skewed to the owners or key employees. The larger the benefit, then the employer will need to contribute to every single employee that's working. And so when looking at an example in the next slide, sorry if it's blurry, but just want to focus on the compensation column, which you can see the dentist and his wife are earning 265,000, wife is earning 147. And so if you look into the cash balance column, is that through the cash balance plan, the dentist was able to contribute 185,000 towards his retirement nest egg, the wife 50,000. So if you look on the bottom left part of the spreadsheet, the total business contributions was 304,000, and from that 304,000, the 285,000 was directed to the wife and the doctor or dentist in this case scenario. So that accounts for 93% of the business funding towards the owner and his wife. Yeah. And so just in summary for the cash balance plan, I think the benefits identified are usually, hey, James, I want to get a retirement income stream that's like a pension. So, I don't have to worry about the investments. My employer is going to be contributing for me, and it's just going to give them a set income stream at retirement. Okay. Benefit to the owner is you can deduct up to 265,000 a year. So there's no other real plan or strategy out there that can offer those types of deductions. And like I said, individual doesn't have to personally manage their account. Some considerations, as I mentioned, steady cash flows. If the owner is consistently earning 250,000 on a regular basis, that allows the strategy to be efficient. Oftentimes, it's not going to be as liquid as other retirement strategies like your executive bonus plan, because there may be potential tax and penalties if distributions are taken before retirement. And then lastly, just like your 401k or any other pensions, it is going to be taxable as income at distribution. On to the next slide. So what is an executive bonus plan? So, how it works is the owner can bonus specific employees and leave out others. So you usually see this in a family-run business or professional services. that some employees are a lot more valuable than others. So it's a way to retain, reward those key employees. And so how it works is the owner is going to determine amount to bonus those key employees or whoever he or she wants to include in the plan. And that bonus is used to fund a cash value life insurance policy or a long-term care policy. The benefit of that is there's tax-free distributions from the cash value policy. And then for the long-term care scenario, it's tax-free benefits if there's any type of long-term care need. Okay. Next slide, executive bonus plan sweet spot. So again, it's that owner that just wants to specify specific employees, whether it's family members, CFO, COO, and business partners. Contributions can be more flexible than a cash balance plan. We had a client last year, actually 2 years ago, did a $20,000 bonus. The first year, cash flow was tight. The following year, he wasn't able to contribute anything to the executive bonus plan. And then the third year, this year, he was able to make up for that with a $40,000 bonus to catch up for that. So it is a little bit more flexible than your. In a long-term care scenario, it's usually best if it's an owner that's older than 50. And so basically they can leverage their dollars by paying out that bonus and then purchasing a long-term care policy so that any benefits used is going to be tax-free rather than taking out from their IRA or other taxable accounts to cover long-term care costs or needs. Okay. Next slide, another sweet spot when looking at the cash value scenario, our business owners younger than 50 years old. So in a cash value life insurance scenario, the younger you are, the healthier you are, the more insurable you are, which the cash value builds and grows at a faster rate. I'd probably say one of the biggest benefits for this strategy for cash value policies in an executive bonus plan is that it's creditor protected. So if anyone were to come after you, they may be able to get your brokerage accounts, your retirement accounts, but they can't touch your cash value in this strategy. Another huge benefit is that for parents, that anything in a cash value policy does not count as an asset towards financial aid, which is huge. So if you utilize a 529 account, a Coverdell account, any regular brokerage investment accounts, that will count as an asset against you when applying for financial aid for college. Next slide. Just some of the broad benefits and considerations. Executive bonus plan is fairly tax efficient in that there's going to be tax-free distributions from the policy. Oftentimes the cash value can be multi-purpose, could be used to pay down debt, pay for education, used as a vacation fund, or as retirement income. Again, it's going to be creditor protected and doesn't count as an asset for education purposes. And then in a long-term care scenario, you're just leveraging your dollars so that in the event that you do need it for long-term care, that it's going to be tax-free. The primary consideration for the strategy is that everyone needs to qualify. So if you're either a smoker, if you're in bad health, that you may not even qualify for the strategy because there is underwriting involved. Next slide. So just wanted to put together two different kind of examples or case studies. And so in this first example, we had a business owner that really valued their chief financial officer. And so CFO was 45 years old, and business owner, as a way to reward the CFO, wanted to bonus them $12,000 per year for 20 years. And so over that 20-year period, that would generate the $240,000 would be tax deductible for the business. And then for the CFO, however he or she wanted to utilize it, would generate $496,000 tax-free distributions from the policy. Yeah. Next slide. So this one was a family-run business scenario. So we had a dentist that the father was the owner of the practice, but didn't really trust the son to budget and save for retirement. The father wanted to bonus out the son, and instead of bonusing out the son directly, move it into this cash value policy. And so the annual bonus was $30,000, and the dad wanted to bonus the son for 20 years. And so the total amount contributed by the business was $600,000, which again is tax deductible, and the total tax-free distributions from the son or by the son was about $1.7 million. Next slide. And so just to kind of wrap things up, it's really important to just understand, utilize Janean as a resource to determine the best strategy to maximize your deduction while creating an exit strategy or building a retirement nest egg. So, you know, with the cash balance plan, I would start with the 401k salary deferrals, then move on to profit sharing. Then there's that additional layer of cash balance plan. With the executive bonus plan, you could use it to complement each of those strategies, or you can use it solely. It's definitely not a one-size-fits-all. So I would sit down with your tax professional or Janean and a financial advisor. I'm always happy to offer some insight to determine which strategy is going to be most appropriate for you and your business. Another key point is really understanding your overall risk, your inflation risk, your principal risk, and your market risk. And again, using that pocket analogy, we want to maximize what money that we keep in our front pockets with minimizing how much we need to pay to the IRS, but also keep in mind that if we don't allocate funds into our back pockets so that when retirement comes, we have something to provide that retirement income, it's just going to be a longer process if we don't, you know, allocate funds towards our future retirement. And then just again, you know, is your money working for you? So I think it's important for everyone to understand that inflation is roughly 3%. And then anything that we're earning less than 3%, we're losing purchasing power. Anything that we're earning in excess of 3% is when your money is actually working for you. And then oftentimes, whether that's investing in real estate, investing in your business, or investing in the stock market, we just want to ensure that the only point in which our money is really working for us is if we're exceeding inflation at 3%. Okay. On that last slide, you'll have my contact information. Be more than happy to send you the PowerPoint or answer any questions that you have. I'll do complimentary illustrations to see what strategy would fit best for you and your business, and then work with Janean to determine what's going to be the most tax efficient as well. So I will open it up for questions, or if Janean, if you had any questions.
Does business have to be a specific entity in order to do this executive bonus plan? Can they be a sole proprietorship, or do they need to be a corporation?
Yeah, it's gonna usually fall in best if it's as an S Corp or a C Corp, but long story short, we need to utilize payroll to generate that deduction. So if you're a 1099 earner, I would recommend that you sit down with Janean to determine if it's more appropriate with the S Corp election or filing as a C Corp, and see what the tax benefits and also considerations of that would be. But yeah, usually if you're just a 1099, you're usually limited just to a SEP IRA contribution, and you're not able to really generate any deductions in wise on that. So any questions?
Yeah, and so if you are if you own if you own an S corp and you are your own employee and you're the only employee, then you can set up this executive bonus plan for yourself, right? It's there
Yeah,
isn't
that's
employees.
Yeah, that's going to be an even better case scenario. Actually, not even better case, but yeah, then you could determine solely how much you want to put aside for yourself. You know, and again, it can be discriminatory in the sense that if you only want to include family members or only want to include key employees, you can pick and choose who to bonus out. For the cash balance plan, 401k plan, and profit sharing, you need to include everyone employed. But again, the benefits will be skewed to be the most favorable for the owner. Yes.
Yeah, that's great, you know, because, you know, these deductions and any money that the owner is putting in their pocket is money that's not going to the IRS. So that's great thing to know.
And yeah, I just think it's just shifting assets. So again, we're putting more money in our pocket, less into the IRS's in the most tax efficient way possible. So, you know, myself and Janine aren't here to make people rich. We're just here to help people save on some taxes and then just keep inflation in mind.
Yeah. Oh, great. Thank you, James. That was a, great presentation. There is one quick question. If I'm a 1099, I can create my own plan too, or through the client I work for? Oh, so I think again, the question is, if I'm a 1099, can I create my own plan or through the client I work for? So I think this is going back to the question about they still need to be on payroll, right? Where they're getting a W-2. And not just a 1099.
Yeah, that's when you would come into play, Janine, in which if they're receiving 1099, they'd want to consider an S corp tax election so they can put themselves on payroll, and then the executive bonus plan you'd be able to utilize. But yeah, the key is to putting whoever wants to be utilized in the strategy and whoever wants to be bonus to generate that deduction, they will need to be on payroll.
Okay.
Yes.
Okay, great. Yeah, if there's we're out of time today. If there's any more questions, can you know, send James an email, or you can always email us at info@smarttaxhawaii.com. Thank you for everyone attending, and we look forward to next week, same time, same place. Thanks again, James.
Yeah, thanks for having me, Janine. Hope everyone has a great rest of the week.
Thank you.
Okay, bye.